Okay, so you really want to own and operate a commercial bank. You picture yourself sitting in a quiet, air-conditioned corner office behind a heavy wooden desk, watching people walk up to a glass counter and hand you their life savings for safekeeping. You agree to give them a standard 2% interest rate. You walk to the back room, lend that exact same money out to a local business owner at a 7% interest rate, and you calmly pocket the 5% difference. You build a nice building, put a trusted logo on the front, and let the mathematics of compound interest do the heavy lifting for the rest of your life. It all sounds so simple enough, but the truth is, it is not that simple. First, we are going to look closely at the strict, multi-million-dollar cash piles you will need just to get the legal permission to open the front doors of your new bank. Next, we will clearly break down the hidden traps in how you actually generate your daily revenue. And we will look at the exact mathematical reason why one single bad week in the broader global economy can wipe out a century of careful, long-term financial planning. Today, most everyday people think a bank is simply a heavy steel vault where money sits safely in neat stacks until someone needs to withdraw it. In fact, a bank is actually a highly leveraged factory that buys raw material on a short-term lease. Think of it like a commercial bakery that promises to give you back your bags of raw flour exactly when you ask for them. But they have already baked your flour into a massive, complex wedding cake that will take 5 years to consume. In reality, the money is not sitting in the vault. The vault is actually almost completely empty. You are running a constant, very fragile balancing act between the exact dollars you owe your customers right now today and the exact dollars other people owe you 10 or 20 years from now. You are operating a complex machine that runs entirely on timing, trust, and razor-thin margins. To fully understand how this precise balancing act operates day to day, you first have to look closely at what it actually takes to build this entire financial factory from the ground up. You cannot simply rent a storefront, buy a strong safe, and put up a sign. Launching a fully licensed commercial bank involves staggering upfront commitments before you even print your first deposit slip. Let us break down the exact costs of starting a mid-sized regional bank today. First, the core regulatory capital. Regulators do not let you operate on pure ambition. They demand hard cash sitting in a secure account before you are legally allowed to accept a single customer deposit. According to the foundational guidelines used by regulatory authorities like the Office of the Comptroller of the Currency, OCC, and the Federal Deposit Insurance Corporation, starting a new mid-sized commercial bank today requires roughly $30 million in pure, unborrowed cash. You have to strictly prove this money exists and is securely held. Second, we must consider the core banking software infrastructure. You are certainly not buying a standard retail accounting package off the internet. Instead, you are installing massive enterprise-grade ledger systems that connect directly to national clearinghouses and global payment networks. Financial technology consultants estimate that setting up this secure digital infrastructure, including advanced cybersecurity protocols and mobile application backends, costs you exactly $2.5 million in the very first year of operation. Third on the list is securing the physical real estate and comprehensive branch security. Leasing a headquarters, building reinforced cash processing rooms, and installing compliant 24-hour surveillance systems will cost you roughly $1.5 million upfront. Fourth, the legal and compliance fees. The specialized lawyers and former regulators who guide your charter application through the government bureaucracy, and consultants who draft your initial risk management manuals will charge you about $750,000 before you even receive your official banking license. Fifth, the strictly mandatory defensive payroll. You cannot run a bank with just friendly cashiers. You must hire specialized anti-money laundering officers, credit risk analysts, and internal auditors. Industry benchmarks published by financial recruiting firms show that staffing these strictly mandatory oversight positions will cost you at least $1.2 million annually. You have now spent exactly $35.95 million, and you have not recorded a single penny of profit. And here is the incredibly harsh reality of the banking business model. Even after spending all of that money, you do not actually own the money you use to run your daily operations. You just rent it from them. Every single day of the year, you are renting cash from ordinary people at a low price, hoping to rent it out to someone else at a much higher price. This crucial spread between what you pay out for deposits and what you earn on loans is your entire financial lifeblood. Let us look closely at two real banks to see how this mechanism actually plays out in the real world when the economy shifts. We will use a contrast pair, Silicon Valley Bank and JP Morgan Chase. Both of these massive institutions faced the exact same underlying mechanism between March 2022 and May 2023. The central bank raised the baseline interest rate from 0.25% to over 5% in just 14 short months. This was a very brutal, rapid shift in the base cost of renting money. Silicon Valley Bank, under the leadership of CEO Greg Becker, took their customers' deposits during 2020 and 2021 and bought $91 billion worth of long-term government bonds. These bonds were generally considered extremely safe by traditional standards, but they paid a very low interest rate, locked in around 1.6%. When the central bank rapidly raised rates above 5%, the street value of Silicon Valley Bank's old, low-paying bonds dropped quite violently. After all, nobody wants to buy an old bond paying 1.6% when a brand new bond pays 5%. By March 8th, 2023, the bank was forced to sell a portion of these heavily discounted bonds and officially announced a massive $1.8 billion loss. Their customers immediately panicked and demanded their cash. In the past decades, a bank run usually meant people standing in a physical line outside the bank building. But in 2023, the panic spread rapidly on digital messaging apps. Over the next 44 hours, depositors used their mobile phones to attempt to pull out roughly $42 billion in cold cash. Silicon Valley Bank simply did not have the cash on hand, and the entire institution collapsed completely. Now, let us look at JP Morgan Chase, led by Jamie Dimon. During that exact same 14-month time frame, they were also operating in the exact same economy, facing the exact same central bank rate hikes. They also held massive amounts of government bonds. However, JP Morgan Chase kept a massive portion of their assets in short-term investments and held over $400 billion in easily accessible cash reserves. Because they did not lock all their depositors' money away in long-term bonds, they could easily afford to pay out their depositors when the central bank interest rates went up. Instead of collapsing completely like Silicon Valley Bank, JP Morgan Chase survived the rate shock and generated a record $49.6 billion in net income for the entire year. The difference between a bank collapsing in 44 hours and a bank posting record profits is rarely about the quality of the people borrowing the money. It is entirely about the precise timing of when your debts are due compared to when your cash comes in. Now, let us walk through the actual math step by step to see how thin the line is between these two outcomes. Imagine that you are currently running a regional commercial bank. We will call this first one the optimistic scenario. You open your brand new doors and take in exactly $100 million in customer deposits. You agree to pay your customers a 2% interest rate on their money. That means every single year, you owe them exactly $2 million in interest payments. You take $80 million of that, deposited money, and you issue 20-year home loans to families in your city at a 6% interest rate. Those specific loans generate exactly $4.8 million a year in revenue for you. You take the remaining $20 million and strictly keep it as cash reserves at the central bank to ensure you can easily handle daily customer withdrawals. The central bank pays you a 4% interest rate on those cash reserves. That generates another solid $800,000 a year for you. Your total combined revenue from the loans and the central bank is exactly $5.6 million. Now, you must subtract the $2 million you legally owe your depositors. You then subtract another $2 million to pay for your branch managers, your electricity, and your software maintenance. You are left with exactly $1.6 million in pre-tax profit. You are running a successful, highly stable business. You have a positive margin, and as long as the math stays exactly like this, you will slowly grow incredibly wealthy over time. Now, let us look closely at the pessimistic scenario. We are going to flip exactly one critical economic variable. The central bank suddenly raises interest rates aggressively to fight inflation. Suddenly, your depositors realize they can get a 5% return by putting their money in a completely risk-free government bond instead of your standard checking accounts. To stop them from taking their money and leaving your regional bank, you have to immediately increase the interest rate you pay them to a full 5%. You still hold the exact same $100 million in customer bank deposits. But now, paying them 5% costs you exactly $5 million a year. Your home loans are securely locked in on strict 20-year contracts. You cannot simply call those families and demand more money. That $80 million in mortgages still generates exactly $4.8 million a year. Your $20 million in cash reserves at the central bank now earns the new 5% rate, generating $1 million a year. Your total combined revenue is now $5.8 million. Next, you must legally subtract the $5 million you now owe your depositors. You then subtract your fixed $2 million for your branch managers, your daily electricity, and your software systems. You are now left with a massive, devastating $1.2 million loss. You did not make a single bad loan during this time. Not a single person defaulted on their monthly mortgage. You did not hire any extra unnecessary staff or buy an excessively expensive new building. The exact same fundamental banking business model, the exact same loyal customers, and just one single interest rate change turned a once highly profitable operation into a heavily bleeding business that is losing $1.2 million in cash every single 12 months. You cannot simply call up and ask the government central bank for a friendly refund. You have to pay that massive $1.2 million financial loss directly out of your own personal core regulatory capital reserves. If this dynamic continues for a few years, your capital buffer drops to zero. Regulators step in on a Friday afternoon, fire you, and sell your bank to a competitor for pennies. This scenario highlights a fundamental reality you must accept if you want to operate in this industry. When you own a bank, your biggest threat is not always a robber with a mask. Your biggest threat is often the calendar. You are constantly fighting a war between short-term obligations and long-term assets. If your customer deposits $1,000 today, they retain the absolute right to demand that exact $1,000 back tomorrow morning. But to generate the profit needed to keep the lights on, you have already committed that $1,000 to a construction company building a warehouse that will not be finished for 3 years. If too many of your customers decide they want their money back on the exact same Tuesday, the mathematical reality of your business collapses. You simply cannot rapidly liquidate a half-built commercial warehouse just to quickly hand cash over the counter. This is precisely why absolute public trust is not just a nice marketing slogan for a modern bank. Public trust is actually the only structural load-bearing pillar keeping the entire fragile mathematical equation from snapping completely in half. If the general public ever stops believing that you have the money, you immediately do not actually have the money at all. This perfectly shows you the deeper truth about the modern banking business. You are not really in the business of holding money, and you are not even primarily in the business of lending money. You are fundamentally in the business of managing complex risk and managing time. You are a professional absorber of financial shocks, operating a highly tuned mathematical engine that converts the short-term impatience of everyday depositors into the long-term patience required by borrowers. If you invest in a bank, work for one, or trust one with your life savings, you need to look directly past the total size of their assets. Look squarely at their liquidity. Find out exactly how much liquid cash they have available to give back today, and measure how much capital is permanently trapped in long-term loans that will not be paid back for 30 years. A bank with a smaller asset pool but high liquidity is vastly safer than a massive bank choking on long-term debt. You are never just holding people's life savings safely locked away in a secure steel vault. In reality, you are standing on a dangerous tightrope, desperately trying to balance the raw flour you owe today against the massive, complex wedding cakes you are baking for tomorrow.